And before we allow people to come, we're going to bring people into the lobby, and while people are coming in, we're going to go over a couple of items about funding. It should be about 3 minutes. And so we're giving people a little bit of a buffer while they come in. So the first thing that we're going to cover is basically startup funding and the different types of phases that you're in. Today, we're going to talk a lot about more mature type startup funding, but I wanted for any early stage folks to know what's out there. Okay, so the first thing that we have here is, this was adapted from one of the MBA programs at UC, University of California system. And what this shows is net cash flow over time. And what most pictures like this show, they depict the valley of death for funding. Because sometimes when you're starting something, you put a lot of money up front and you don't generate net revenue until a long period of time. And so this was a model, and like all models, you know, they're wrong, but sometimes useful. So what we can see here is, if you're doing early stage, like if you're working for a university, you can go after research grants, or if you're partnering with a university, you have to research grants. The next phase is these development grants. And development grants are things more like small business innovation research grants, small business technology transfer research grants. Typically, you can get money up to, well, first round is $250,000, typically up to $750,000 on the third round, although those are less common. Then there's founders, friends, fests, and the last one is fools, early stage funding. And so what you do is you can get friends and family, and people will either call this seed or truly angel, because you might not even be revenue bearing at that point. Then the next phase is angel investors up to 500K, and then venture capital, 500K to 50 million, private equity, 2 million to 50 million, and IPO, merger and acquisition. Now, depending on where you are in the country, these amounts are different. So in the land of Alaska, where I worked before, we typically saw you could cut those amounts in half. In Oregon, they might be a little bit less, depending on what they're doing. It might be a little bit more. In Silicon Valley, it is likely completely different. And what happens is, it's usually dependent on the investor community. If you go online and you look at any law firm or investment fundraising site, you will notice that this is different. But basically, there's a variety of information out there. If you have any questions about early stage fundraising as a company, I'd be happy to talk to you. But that said, we have some excellent panelists today that will talk you through later stages, and especially growth stages. So thank you for joining us today. With that, I'm Adam Krynicki from the OSU-Cascades Innovation Co-Lab. And we're going to go through a couple things today. We did our quick overview of funding types. We're going to do an introduction to our hosts and panelists. We have a land acknowledgement and a panel discussion, of course, and feel free to ask questions. This is going to be fairly casual. With that, I want to introduce you to our co-host, Renee Miller.
Hello, thank you all for coming today. I'm so glad so many of you joined us in person. This is awesome. Thanks so much for joining us on Zoom for those of you who are virtual, and we are just thrilled that you're all with us today. So before we get started, I'm going to read a quick land acknowledgement. I'm Renee Miller from the OBI and OTRADI. And OTRADI would like to acknowledge the land we're all on, wherever we may be. OTRADI conducts business throughout Portland and the rest of Oregon, and is making an effort to acknowledge the history of the area and work toward decolonization of the bioscience industry. Portland rests on traditional village sites of the Multnomah, Cathlamet, Clackamas, Chinook, Tualatin, Kalapuya, Malala, and many other tribes who have made their homes along the Columbia River. Please join us in acknowledging the land we're all on here in Bend and throughout Oregon. To learn more about Portland's native, diverse, and vibrant community, please read Leading with Tradition, which is a document created by the Portland Indian Leaders Roundtable. And Hazel will link to it in the chat, and I'd be happy to send out the document to anybody who would like to read it. So I'm very quickly going to introduce our moderator and our panelists today. Adam Krynicki is the executive director here at the OSU-Cascades Innovation Co-Lab. Adam has over 15 years of experience in startup acceleration, funding, and IP, and he is an expert at building initiatives that support innovators, entrepreneurs, and their communities. Next up, we have Rod Ray. He's over there. He might be off camera for you. Come on over, Rod. Glad you're here. He was the founder of Bend Research. His expertise includes advancing pharmaceutical processes and products and commercializing products in electronics, energy, medical, agricultural, and space industries. He holds a bachelor's, master's, and doctorate in chemical engineering, as well as quite a number of patents and publications. And we have Fred Siddiqui, Managing Director at Lugano Ventures and BIG. Prior to Lugano Ventures, he served as CEO and chairman of the board of Axis Surgical Technologies Incorporated, now Trice Medical, and Advantis Medical Systems, and played a key role as a principal of Silicon Valley Venture Partners since 1998. He has a bachelor's and master's in engineering as well as an MBA. And Hazel will put in the chat links to all of the panelists, moderators, LinkedIn profiles. So I want to hand it back over to Adam. Thank you so much. If you have any questions, we're going to have a Q&A section. And for those of you who are joining us virtually, please put your questions in the chat. Thank you, Adam.
So thank you for joining us today. Our first question. Trying to build suspense here, Rod. So our first question for the panel is, when should a CEO be raising funding? Rod, do you want to kick us off?
Sure. When you need it is one answer, but that's not very clever. So when should you raise funding? You know, the Adam's area is early on. How do you just get going, and where do you get that money? And he knows a lot about that. Later, which is when we were mostly raising money, the one answer is when you have a product line or a service or, you know, article of commerce that is mature enough that that there's enough value for people like Fred that you don't give the whole company away to raise the money. So you want to kind of balance between getting the money in to go through the valley of death and your growth rate and all that, but not getting too much money that you gave too much of the company away. And another piece of it is don't give too much control away. So if you raise too much money too early, you can lose actually control of the company. And so that's sort of probably a good start. And all right.
So Fred, what do you think?
No, first of all, I want to tell you that I'm by nature an entrepreneur who started companies, not just a financier, because I'm going to share with you the experience that the person has as a founder and CEO to raise money. And that is the job of a founder of CEO right from the beginning, to understand the money is the essential part of running a company. Raising money is a continuous issue for a startup, even the companies that matures, because the burning of your an expense is continually increases. I was giving this example to many of my team members that the money is the fuel of the engine. And any time that you fly this plane that doesn't have a fuel, will be drop. So therefore, it should be a culture of the founder teams and the CEO to understand raising money is their big part of responsibility.
I guess one small thing to just add is revenues don't hurt either. And the more revenues you have, the less money you got to raise if your margins are okay. So.
Well, that leads to an interesting point, which is, you know, revenues ultimately support your fundraising efforts, right? And it's something that, do you think it's, I mean, you've done a variety of things for early stage fundraising or invested in companies. How important are revenues towards anything beyond a venture round?
Yeah, I mean, Fred, I'll let Fred talk more about that, but you know, they even call it pre-revenue and post-revenue when you're out raising money. So it's a really big difference. If you're actually selling stuff and the market is accepting it, you're going to do a lot better. And that's what can carry you into venture capital and private equity and away from angels and that kind of thing.
Yeah, the revenue absolutely gives us the freedom of running our own destiny and being in a position of negotiating with investor as well. Again, going back to my experience, because I have done life sciences, that they did need a lot of money. Until we were able to come to a revenue, we had to bring about $60 to $100 million investment in the development of the prototypes, products, going through the clinicals. Life science doesn't get to the revenue very easily. So one has to be aware that the VC is a part of the devil to deal with. And it's not going to be raised money. This flow chart that Adam showed was really a very reasonable process of how you raise money. But when it comes to a product that related to biotechnology and things that have to have clinical studies, you need to see that the risk level is very high. In a medical devices, when we raise money, of course, we go through different phases of valuation. The first phase is, of course, higher risk, but it reduces when you go passing the clinical trials. But until you get to the clinical trials part, because you need FDA requirements or you need IRB approval, that takes a lot of funding. So
How much funding?
well, I again, back to my experiences, goes over $10, $20 million for those phases. Then it comes back to the fact that, yes, you negotiate the valuation when it go post-clinical trials. But anytime I've understood from the VC, they always in a position that they can negotiate their value. And now that I'm a VC, I'm also as hard as they were, because it was the experience they have is not always easy either. There's a lot of them do lose money in this area. I'm not exactly know the percentage, but they say 1 out of 10 that they make okay with it.
So the next question I have is about the types of funding that you've either used or worked with. And, you know, Rod, you and I were talking a little bit about some of the things that you did with Pfizer and the equity deal there, as well as Bend Research had a couple of startups companies that they spun off. So talk about the types of funding that you've used, and specifically, you know, talk about your experience with equity with the Pfizer deal and startup companies, and just inform this group about your lessons learned there.
Okay. Yeah. Okay. There's a lot of things that I did wrong, so I don't have time to tell you all those. But yeah. So Bend Research, it really simplistically, when we sold it, it was like 40 years old, and it had a first half, which was kind of smaller company, and we did all kinds of different things like space and water and electronics and things like that. And our second half was when we transitioned into pharmaceuticals, and we became a pharmaceutical technology company. And the funding needs and the way it all worked were quite different. So in the first half, what our business model was to exactly what Adam had on the slide, was we wrote government proposals and developed technology. It was the SBIR program, which you're probably all familiar with. There was a time where Bend Research had won more SBIRs than any other company in the United States, actually. So that allowed us to build technology and IP, and then go license it, or attempt to license it to companies for royalties or other value. We had trouble with the licensing side. It didn't ever really give us enough return. So I don't know if in desperation is the right way to say it, but we started forming our own spinoff companies, and those were venture capital deals to fund the spinoff. So we didn't take equity in, we didn't sell equity in Ben Research. We sold equity in a company we formed. And one of those worked out really well, which is now Sutera in town here. It was called Concept first. We got that one right. And that one was pesticide or pest control with drug pheromones or bug pheromones, and it was pretty easy approval process. So to Fred's point, it took a lot less money than a lot of other things do. But we had 2 or 3 other spinoffs that we started up around some separations technology, like compressed air water removal or oily water cleanup or things like that. And generally those did not work out for us. And I think the fundamental kind of summary of why not is because they really were product lines, not companies. And we tried to start a company around what really should have been a product line. And in the end, it turned into a license deal, and we went through all this, and we should have just licensed, even though that was hard. So I think that's something to really watch. Do you actually really have a company? Or if you do, and it's going to stay small, then you can just sell it or merge early. But that was our mistake in 2 or 3 of these, probably 3 of them. And it was, we'd raise the money, we'd have a CEO, we'd raise the money. That was his job. Like Fred said, it wouldn't work out very well. The CEO would leave, and then I would have to go take over the company and figure out what to do. And that's how it went 3 times. Mm-hmm. And then as far as Pfizer goes, when we started working for Pfizer we started working in the drug business, it was for Pfizer. And ultimately they were giving us the best problems and the most revenue. And they wanted all of our capacity. So we went exclusive, which is maybe, makes you wonder strategically. So they were our only customer for 10 years. And at the end of that, it was 45 million in revenues 15 years ago. And they bought a little bit of equity from us actually to give the founders some money, really was the reason. And so that was different because we were doing bigger stuff. Pharmaceutical technology cost a lot of money to do. And so that kind of fundraising was, a different, and that was a strategic deal. It wasn't VC or PE, private equity. And then finally at the very end, we sold the company. And that was a private equity deal. And I'm happy to talk about that and how that all went. But I think it's not my turn any longer. I'll let Fred say some stuff. Sorry.
So what was the original question?
So the original question is, basically what types of funding have you used? And if not used, maybe talk a little bit about the types of funding that you've worked with and you're familiar with and you've given, right?
Yeah, I usually worked with the venture funding in Silicon Valley, and they are pretty much familiar with the process of life sciences because the venture firms are selecting a different sector of the economics that they are very familiar with. In life science, you find specialized people in that as a partners. They're medical doctors, clinicians, and all kinds. So they do a significant due diligence to see where this company is going. And their investment, as I mentioned, goes through multiple phases. But the key thing that they are looking for, and we are doing the same thing now, is the team. There is a saying, just like a real estate, that you have location, location, location. They look at team, team, team. And having the team experience, especially in life sciences, is important because it's a niche that not easily understood by outside people. It's a multidisciplinary work. It takes all kinds of engineering. It takes doctors to be involved from a very early stage. And it's also FDA requirements that is very extensive and expensive.
So Fred, who would be on your perfect team? I feel like I'm on the dating game. Who would be your perfect date?
As someone who has been through the experience of what it goes with a startup in life science, and let me give you a good news though, because we came from Silicon Valley. When I say we, have a couple of people that we happened to meet here in Bend just about a year ago. And then we found this environment very conducive for having ideas and projects that Astar has done before and built companies. How we can really mimic that in some degree in life sciences, because we heard that this area has gone through some of that in the past. And with that, we discovered that if we are financing startups, who is going to be the one running these companies? We are actually, the way we are connecting with Adam is to find out through his connections if there are startup CEOs that we can work with, because there is funding available and there is projects available, but the leadership really matters. And the point is that now we started big, BIG, is Bend Innovation Group. Our focus is to train some of these people who want to be in the field that we can trust working with them. So the combination of our experience and money will give us more security to the exit of the company. And so the good news is that, yes, the experience of advisors in connection with the people who want to be in this field would give us a better feeling toward the outcome.
I want to make a comment about the team, because you're absolutely right. It's interesting though, when you're building your team, it needs to be a team, meaning you've got to have people that actually get along. So you need the technical expertise and the financial expertise and the marketing expertise, but these guys are going to see whether you're getting along or not and whether you're really a team. And then the next thing I would say is, if possible, it's nice to have people on your team who are going to be able to help you raise money. And they don't have to be polished. They don't have to be, really good speakers and all that. They have to be genuine and part of the team and give a good story to the investors. So it's just good to keep those other things in mind when you're building a team. It's a little more than just who's the best technical guy. And I know you know that too. So
That's interesting. So talk to me a little bit about, before we move on to our next big question, talk to me a little bit about, what do you mean by get along? Does that mean get along at work? Does that mean get along like your buddies? Is that something like, you have competent people just in their position? What do you think?
yeah, so there's the base part, which is just, they don't irritate each other to the point where they can't work together. But I would just say, because to be brief about it, is accountability to each other is the key. Doing what you say you're going to do and having respect and empathy for the other team members and being accountable.
When we're looking for a team, we do some degree of due diligence and filtering, and we came up with this abbreviation of ICD: integrity, competency, and delivery. If these three things are in every person, we only pay attention to that. And with that, the objectives in the center will work out really well, because these people understand the idea is not individuals. The chemistry, all that is good to have. But as a group, we like to pay attention to the value we're creating together. And this has been a very unique process and culture in Silicon Valley. You see people of very different background. You see a lot of the diversity in every company. I had a company that had 100 people. There were about 67 different countries people were working in there. So you can imagine that really is important, yeah, because there is a relationship culture and all that. But it was the CEO and leadership that brought the issue of ICD, where everybody understood integrity is a common thing. Everybody understood delivery is an important thing. And if you don't have that delivery and competency, then you're not part of this group. You can be recognized very fast, because the burning rate at these companies are huge. And the job of CEO to watch, to see who is delivering and who is not, and then it surfaces itself, and the people have to, there's a revolving door, and that's very costly. But that's why training of these individuals from the beginning is very important. In average, we have a CEO of a startup about 3 years or 4 that they leave. And they possibly not because not competent, but it's the burning of so much effort burns out these people as well.
That's really a cool point about integrity, competency, and delivery. I think everyone wrote it down. I just watched a lot of pens go down on paper. And it's a really important point about a team, right? Is that you have to be, integrity in some ways are defined as doing the right thing even when no one's looking, right? And being truthful with one another. So moving on to our next big question. What is the best way that you've found to find the right funder, right? How have you gone about finding the right funder for you?
Yeah, so that's a great question. That was my favorite question on your on your questions. The first word I would say is you're looking for a good relationship with your investor. And that's really important because they're going to own part of your company, maybe a whole bunch of your company. They're going to be on your board, and you're going to go through tough times with them. So you are looking for somebody who believes in what you're doing and has the money, but particularly somebody that you can have a good relationship with. And so then to get to the answer of the question of how do you find them, the trite answer is networking and go in and start asking a lot of questions. There's another thing you can do if you're going to do a big enough deal. You can get an investment banker, and the investment banker can help you find them. But really, in my opinion, and anyway, it's just asking a ton of questions and meeting a ton of people and finding that fit.
And how did you go about doing that?
Yeah, well,
was it cold emails, cold calls?
Well, we didn't have
walk into
email.
Office?
Most of this we had no email.
Okay.
This is really a long time ago. We would ask people we knew who had raised money, who they used, and then go from there.
Yeah.
And they would say, I mean, you kind of said this earlier. They would say, well, this one isn't a fit for us, but try these guys over here. And that's kind of how we did it, actually.
So it's like knocking on a lot of doors and reaching out to a lot of people. Yeah. So Fred, you can speak to how to find a funder or find the right fit. But the other part of the question I have for you is, how do you want people to find you as a funder? Like, what's the best way for somebody to reach out to you in a way that you feel comfortable with, or in a way that's best for you?
Let me give you an example. I had a partner with Prism Venture, very popular venture firm in Boston. And he himself and his firm was very well known. Then he moved from Boston to Springfield, which is a village suburban of Boston. When I wanted to go see him, I said, wow, you went too far. This village out here took me about another hour to get here. He said, see, I build a name and reputation. When people need me, they come to me. So the issue is they will come to you and they find you. And we as a VC firm, we have to continually filtering that through relationship that we have with others. Otherwise, you get a lot of these business plans, you get a lot of solicitation that you don't want. So generally, people do find, but how you filter to reduce that, not to take your time, that is the issue. And we actually filter through relationship, through people who know the projects, and they know others, and that's how we pick. It doesn't happen by somebody send you an email and say, here's a business plan, look at it. That is not the way it's going to work. I did that in my 20s back in Silicon Valley, and one knocked on the door of Sand Hill Road. I left my business plan in front of every door, and nobody called me back.
So on that note, you've never logged into Gust, it sounds like, to solicit deals or look at venture deals. You don't have a form on your webpage that says, send us your information. It's really through referrals.
There are firms that like Planet Earth has multiple people who go out there and visit people. For us being a small firm, we get through connections.
Through connections. It sounds good.
Yeah.
Rod, you had something to add.
Yeah, well, Fred, you made me think of a cool thing that that we did that worked. There's all kinds of ways to market your company, of course, and you know, and get the attention you need so that you find the right funder. But of all of the ways to do it, the one that always worked best for us was shows or trade shows, and doing posters and having a presence there where you can show off what you have and meet people in person, because people like Fred are there because it's really efficient for them. They can go around the show. And so that's just, it's a little bit of a vertical detail, but it really, really worked for us.
What shows?
Well, for us, it was all the pharmaceutical technology sort of provider kind of shows. And there were shows for that. For your device, there's probably a particular set of shows that people would go to.
Let me share with you a statistic of how a VC invests in average. A VC of, say, having a $500 million in their fund, they probably see about 40, 50, or even more deals that they actually see the presentation in front of the partners. That takes a lot of time of VCs to put their partners together to listen to a presentation. Do you know how many they invest through all those in 1 year? 2 or 3 is about right. So you can see this filtering process is pretty huge. But I don't want to disappoint anyone, because life science has a very attractive track record in successful exits, which you don't see that outside of that. These exits are in hundreds of millions of dollars sometimes. So it makes up for all the work that you do. So I'm not going to disappoint anybody that way, okay?
So I have one last question for this panel, and then we're going to open it up. So I'd encourage you to think about the questions that you all have. And if you're watching online, please submit them to the chat. We'll begin asking the questions. But my next question is, what are some of the biggest mistakes that you see people make in this fundraising process?
Yeah, I mean, one of them is the one I mentioned earlier is, do you really actually have a company, or is it a really cool technology that should be disseminated, you know, commercialized, marketed another way? So that's one question.
Such as licensing?
Yeah, like licensing.
Yeah.
Or yeah, like licensing, or merging with somebody that has a complementary product. Yeah, and so yeah, I mean, and that also brings up the exit part is, you know, the exit, the nature of your exit is important. I mean, sometimes people actually want to hold a company for a while and have it make money and build more value. And your investors can get antsy. So that's one of the reasons you got to have a good relationship with them. Other times you're going to do a strategic deal and merge, you might merge, or you might get bought by a company instead of a fund. And so that matters. So it's just looking out ahead. What kind of exit are you doing this so that 3 or 4 years out, you're going to be able to sell it and make a whole bunch of money, or is there another goal?
Yeah. So looking at having the end in mind is really important to avoiding those mistakes. What do you think, Fred? So,
yeah, I think one of the mistakes is to go too early to investors. Early meaning that you should have your team assembled to begin with. They're not there to work for you and help you on building a team. They have to see a recognized group of people that necessary, meaning the core competency is in that team already. And then you have a tangible, if it's related to a device, a tangible prototype should be there, because it's hard for them to envision through presentation. It's better to be tangible and see things. And if you have your clinical trials done, then that's obviously a perfect position to negotiate where you are. So these are the process of where you are and how much money you need and when. In medical device, the risk level really goes low when a physician has the IRB, internal review board, that he was able to use the product on human. And most of it, because of the FDA, and they will not allow you to do that in the US. Some companies, they go overseas and they do that, and that helps too. So if you have a data available that it shows clinically works, that's the best time to do it.
So Fred, just to follow up, I know I lied to y'all saying I'm going to open it up to the floor, but so as a funder, right, there's a number of people that have probably made it pretty far in due diligence. And at the last stage of due diligence, or, you're getting to basically towards closing, and you discovered something big, or you discovered something that killed the deal. What's the things that typically kill a deal with a VC in your mind?
Okay, so these due diligence process, the average takes 2 to 3 months. And during that period, you really should be able, the VC should be able to find what's wrong with the, well, let's see, their undercovered stuff that you don't find. We also go and meet with every single person in the company separately, and to find if they're all communicating the same thing. So these are the details that one has to work. Once the term sheet is prepared by VC, that's too late to back off. And that term sheet has a period of 2 to 3 days because they don't let you go shop around. Because it happened that if you met with other VCs and you pull them in a way that they are being shown interest, it's just like buying a house. You got multiple offers, and you keep that secret, and then one offer accepts. Term sheets is a similar thing. You don't want to leave it out there for people to shop around. So no, once the term sheet is prepared, it's very hard to let go.
Okay. So what, do you want to follow up with anything on that, Rod? Okay, so what questions anybody have? I'm going to hand around the mic and we can make sure that folks online can hear. Any questions from this group?
Good people are hard to find. Hold on, Karen. Karen, I'll bring you the microphone. Hey there, Fred. You mentioned good people are hard to find. I'm curious, as an executive recruiter, we do a lot of C-level succession exit recruiting. How do you go about finding those people? And what is your criteria?
Let's say everybody's good. They are good people, but we're looking for experienced people with the track record, again, with the ICD I mentioned earlier. We find people through executive search. They have been very helpful to us, obviously, nationwide connections that they have. They're also doing their filtering and due diligence. That saves a lot of time and management.
Hey, first, thank you. Second, how can VCs really help the companies they invest in or the companies themselves get the traction that they need from the investment that they're receiving, especially in those early growth stages where you're going from a minimum viable product into something that's repeatable?
Yeah, I'll just say a couple things and let Fred go on that. The first thing is they've seen a lot of companies, and so they can recognize some signs or some they can recognize some problems coming. Like, for example, maybe your product isn't quite ready and you thought as you thought it might need more service out, it just might not be quite what you thought. They can recognize that. They're not going to fool themselves like you might fool yourself because it's your technology. That's one thing. Another thing is, and this is really important in the front end of the deal, making sure they have more money to give you if you need it. That's another one, because that's their job. It's one of their jobs. So those are two things. I think there's a lot more, but
As I mentioned earlier, that we are different than conventional VCs. We do get involved in the development of the company. To lower the risk, we bring our own experience and resources to it. We enjoy the development process as well. We do not go into companies that the CEO is continually asking for more money. Money is not always the solution. We have to put that in front of the board, that there are other angles that we have to review before we just pour money after money.
Any other questions in the room? I'll come with the microphone.
oh, this is going to be a tough one.
This worked. So Fred, on the VC side, do you agree with the VCs that seem to have really increased their nasty terms with the 3x liquidation preference, participating preferred, et cetera, et cetera, et cetera? And is there any way to avoid those
What did you say? Nasty terms?
nasty terms? Yeah. It's redundant when you're talking about VCs, but yeah.
Yeah.
And I was one.
That's why I don't call myself a VC, you know. The terms, as you say, 3x, 2x factor is all a matter of negotiation. Obviously, when you're in a position that you need the money, then you have to agree, especially when I said that you're running out of fuel. Those terms come in there with the preferred shares and all that stuff, what dilutes everybody. We've been through. I started companies with having 80% down to 5% because we needed the money. It was a company, we raised $60 million and the whole thing went down to 2 because they brought multiple of their own relationships and CEOs. So they take control of things in that way too. Actually, most of the VCs in Silicon Valley do not want to get involved if they know that they will not have the control. Even if they do come initially with giving you the 80%, but you have to know by the end you will have 5 maybe or less.
Yeah, that's why I mentioned that earlier. At the get-go, you got to realize how much control you're really giving up, especially the earlier the deal.
We do have a question from our online audience. The success factor of a researcher scientist is quite different from that of a business executive that leads or manages a successful biotech company. For a business exec in biotech, what do you think are the key factors for success for the personal career growth and for the growth of the company?
Well, I mean, some of this is going to sound trite, but good leadership skills for the starter. It really helps in these kinds of companies if the CEO has some technical background and understands what you're actually doing. That's not essential, but it really helps. So that's one thing I would say. And then back to the teamwork thing, you need somebody that can build a team and then run the team and hold them accountable. And you need somebody that can think strategically. I mean, what I think a CEO does more than anything else is look out for patterns out in the world and then configure the company like with those patterns in mind. And so those are things I think are really important.
No, I agree. Leadership is the key thing to companies, especially startups that goes through roller coasters, and they should be able to handle that. Because everybody is look at the leaders in the way the company runs. So the leadership has a lot of factors of personality. They are compassionate people. They're visionary. They can vision the future and things goes. They also should be able to create continually challenges for the team. They look up to success. There's no monotonous day in a startup company. It's always you got to follow the new involvement that they have. So being a leader there is is a key thing.
And they've got to be cool under pressure and not show fear, because it's always there in this kind of company.
I see the startup founders nodding right now. They all understand that point. Any other questions? Anybody online? Anybody in our room?
Yeah, I just had one quick one. As an investor, how much are you, how concerned are you over drug price controls or risk to the accelerated approval pathways? You know, a lot of the regulations going on. How in tune are you with that, and what does that mean to your decisions?
Yeah, we actually look at all the issues related to futuristic concept of where we can envision in the market, in regulatories, in the area of competitions. We hire expert to look where things goes in the next 10 years. Yeah, those issues are all part of the investment process. In some of the market that we look at, they have to be over a few $1 billion, because when you looking down to the level of our companies, they might be a very small percentage, but still they are playing in the game. But if you start with a market size that they are in $100 million and some other competition comes and take over, then you are out. So these are the kind of factors we have to analyze right from the get-go.
We have another couple of questions online. What are the important points to cover in the initial investor pitch? I would assume covering the problem, solution, market, and team are important. Anything else?
How much money you're gonna make?
This is an old concept of Boston consultant years ago brought that up. BCG, you guys probably heard. They said there are 3 things you got to have before you, in your presentation, before you go to investors or even adding another team. And that would be, again, back to who's the team, what's the market size, and what's the product or technologies. Those has to be defined, and then you have the 3 pillars to work with.
Anything else beyond that that should be added to a pitch deck?
I always thought it was important to be, maybe not in the deck, but anyway, I always thought it was important to be ready for the questions like what could go wrong, you know, where are you worried, you know, that sort of thing, because the answer is never not, I'm not worried about anything. It's always, you know, and that kind of thing, maybe not in the deck, but be ready to say it or talk about it.
Yeah, if you show that you're prepared and you've done the pre-mortem, why this could die, it shows that you're anticipating all the risks and the things that the investor is going to be exposed to, right? So what other questions are online?
We have a question that is, what suggestions do you have on how a lean company with limited cash can attract top C-suite leadership team?
Ooh.
Well, one way is to get them excited about your technology. That's probably the main way. And maybe the team. In our case, we were well known enough, people wanted to work with us, so we could attract people just by like our name. And then if you can suck them in by getting them to sort of brainstorm with you, or, you know, how would you do this? How would you do that kind of thing, and sort of build the relationship, they'll be more likely to join you. I don't know.
Yeah, I would think it's important that you can bring someone who gets passionate with what you have, and then you get along with. That would be your number 2 in the team. So without having so much cash, the attraction has to be other places. And to get passionate about the technology in the future, that's a job of a founder.
It definitely sounds like you're always building relationships, whether it's with the investors or potential C-suite talent or potential employees, advisors. It's almost like a nonstop process, right? Any other questions that we have online or in person?
Hi, I've worked for a couple of startups in Silicon Valley. So I was just curious about your comment in terms of attracting C-suite talent. Neither of you mentioned equity or stock options. So I was just curious about what the current state of the world is around stock options.
Yeah, I mean, in this kind of company, you're not that's essential because they're taking risk beyond. I mean, they're taking risk with their time, their reputation, and their potential. So the equity is really important there.
Yeah, well, I agree. The stock option is the second cash value in Silicon Valley. People actually were going to use that as a certificate, getting their shopping done, because it became a commodity that had some value to it. It is key thing for a startup. That's an incentive for sure.
All right, I think we have time for maybe one more question.
What's your best war story? What's the craziest thing you've done to close a deal or get a deal or just keep the company running?
This is awesome. Thank you for closing with this question. Rod, you're up.
Well, this is sort of on point, but it's a cool story. The strategic that we sold to, which could have been a private equity firm, so it's pertinent here, because we could have done the deal we did with a strategic or a private equity firm. But I'm in this. We've had all the presentations and all of that, and the CEO and I go off in a room by ourselves, okay, and we're sitting there, and he says, "Okay, how much?" And I said, "Okay, I'll get to that. What I need first is your promise that you will do good things for my leadership team and, allow them to grow and allow them to do well. The company needs to stay in Bend, Oregon, and you have to spend $50 million in capital once you buy us, and oh, by the way, the price is X." And he came back ultimately with like 1.1 or 2X. So, but that's kind of my worst story for actually closing the deal. And he liked that. He liked that it didn't begin with money. And that was the beginning of a relationship. He could see where our values were, if you will.
Well, I have a lot of stories. I don't know which one to start with, but one of them is interesting, always comes in my mind. We had a broker from Santa Clara was getting us money from Europe. And so we flew out there, and I made sure I bring my family in case the deal doesn't work. So we have a vacation there. So we went to France, and then we went to a hotel room, and the investors came in, and the broker who dealt with this came in, and they said, "Okay, now we're giving you $4 million, but the deal was that we give 5% to the broker. But we want to see you as a CEO in a separate room, the investors." So when I went to separate room, they said, they did one phone call. It's not worth the 5%. And we putting all this money in, now we have to go into giving these guys all that. They should go into the development. Would you agree to negotiate with them to bring it down? I said, "Well, let me see what we do." And we talk, but then he said, "Okay, you have your family here, so we will have dinner in this restaurants." When we went there, he said, "I decided not to invest in giving all that cash to these brokers." And I said, "Without them, we wouldn't be here, and without them, we wouldn't be talking. So I guess the deal is off." So when I went back to the room and told these brokers that they are not investing, so of course they got very depressed. And I went on with my family on vacation thinking that's all over. When I came back to US, my secretary said, you know, the fax machine is going. I said, what's in there? He said, the contract. They sending you the money. So that was the kind of risk sometimes you have to take to maintain the integrity. And we don't know if they were testing us either.
Great stories. Anything to add before we?
You're amazing, Adam.
Well, actually, if you want to keep going, we can go on for the next couple minutes. So I would just wanted to thank everybody for joining us today. This is a really great thing to dig in. It's a great introduction. Both Rod and Fred are wonderful, and they've encouraged us that if you have questions, please reach out to Renee or myself, and we have our contact information up on one of these slides. But before we exit, Fred had mentioned BIG, Bend Innovation Group. Please check out the website, and I would encourage you to engage and talk about the growing biotech innovation community here locally. And if you want to reach out to Renee or I, we're going to leave our slide up here for a little bit, so you can write down our email addresses, check out our websites, things like that. Feel free to connect with me on LinkedIn and Renee on LinkedIn. Even if it's something that's not pertinent now, it will be in the future, right? And so we encourage you to reach out, but thank you again for coming. If you have questions, please send them along. We're happy to make intros, and let's continue to grow the biotech innovation here in Central Oregon. All right, thank you so much.